Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. This video is for educational and informational purposes only. The information provided is not a substitute for professional advice from a qualified insurance professional who can assess your individual needs. Always consult with a licensed agent before making any decisions about your insurance coverage. There's a phrase in the insurance world that gets thrown around so much it's basically lost all meaning: full coverage. A few years ago, a guy named David in San Diego thought he had it. He paid his premium on time every single month for a policy he bought online in about 15 minutes. The website promised great rates and full coverage. He printed the insurance card, put it in his glove box, and didn't think about it again. He was covered. He was safe. Then came a Tuesday afternoon on I-5. Traffic was slowing down. He glanced at his phone for a split second and boom, he rear-ended a brand new Lexus. It wasn't a huge crash. The bumpers were dented. Nobody seemed hurt at the scene. They exchanged information, and David called his insurance company, confident that his full coverage would handle it. The first sign of trouble was the repair estimate for the Lexus: $9,000. David's policy had a $5,000 limit for property damage. That was the state minimum. His insurance company wrote a check for $5,000, and then the other driver's insurance company sent David a bill for the remaining $4,000, plus the cost of a rental car for 3 weeks. David was stunned, but he figured he could handle it. He'd put it on a credit card. But then the second letter arrived. It was from a law firm. The driver of the Lexus, who had seemed fine at the scene, was now claiming a severe neck and back injury. He was demanding $100,000 for medical bills, physical therapy, and pain and suffering. David pulled out his policy. He frantically searched for his coverage limits. Buried on page 3, he found it: bodily injury liability, $15,000 per person, $30,000 per accident, the absolute legal minimum required to drive a car in the state of California. His full coverage policy, the one he was paying nearly $200 a month for, was about to cover only 15% of this one claim. The other $85,000? That was now David's personal problem. The law firm made it very clear. They would go after his savings, his investments, and if necessary, they would garnish his wages for years to come. David's 15-minute online purchase, his belief in the myth of full coverage, had just put his entire financial future on the brink of collapse. This story isn't an exaggeration. It happens every single day on the freeways and surface streets of California. And the terrifying truth is that millions of California drivers are in the exact same position as David and have absolutely no idea. You might be one of them. You pay your bill, you have that little card, but do you actually know what is in that 20-page contract you agreed to? Do you know with 100% certainty what happens the moment you cause an accident? That uncertainty ends today. In this video, we are going to tear apart the California auto insurance policy. We're not going to talk in confusing jargon or legal essay. We are going to translate your policy into plain English so that you can understand exactly what you are paying for. By the end of this, you will be able to look at any insurance declaration page and know instantly whether you are properly protected or dangerously exposed. You will learn the secrets to getting the right coverage for your specific situation without getting ripped off. We are going to build your perfect policy from the ground up, starting with the single most important, most misunderstood, and most dangerous part of your insurance. First, let's be crystal clear. California is a different beast. The insurance that works for your cousin in Ohio is wildly inadequate here. Why? Because the risk is astronomically higher. We have more drivers, more cars, more traffic, and a much higher cost of living. That means the cost of car repairs is higher. The cost of medical care is higher. And critically, the size of the lawsuits is much higher. Driving with a weak insurance policy in California is like walking into a gunfight with a water pistol. The foundation of any auto policy, the part that protects your entire life's work, is your liability coverage. This is so important I need you to burn it into your brain. Liability coverage has nothing to do with fixing your car. It has nothing to do with paying for your own injuries. Liability coverage is for the damage you do to other people. It is your financial shield. When you are at fault in an accident, and the other person is injured or their property is damaged, this is the pot of money that pays for their medical bills, their lost wages, their car repairs, and their lawyers. This is the coverage that stands between a lawsuit and your bank account, your house, and your future income. Every California policy breaks liability down into two parts: bodily injury and property damage. and you'll see it written as a series of 3 numbers, like 15/30/5. This is the code that defines the strength of your financial shield. And the state minimum, the 15/30/5 that David had, is a financial suicide pact. Let's decode it. The first number, 15, stands for $15,000. That is the absolute maximum your insurance will pay for the injuries of any single person you hit. $15,000. In California, in a state where a single ambulance ride and an ER visit can cost more than that, what happens if the person you hit needs an MRI? Surgery? Months of physical therapy? What if they can't work for a year? That $15,000 is vaporized in an instant, and every dollar beyond that comes directly from you. The second number, 30, stands for $30,000. That's the maximum your policy will pay for injuries for the entire accident, no matter how many people you hurt. Imagine you run a red light and T-bone a minivan carrying a family of 4. All 4 are injured. Your policy has a total of $30,000 to split between them. That's $7,500 per person. It's nothing. It's an insult. And when that money runs out, their lawyers stop talking to your insurance company, and they start talking to you. But the most criminally insane number of all is the last one. 5. $5,000 for property damage. Take a moment and look around you the next time you're in traffic. How many cars do you see that are worth less than $5,000? You could be driving the oldest clunker on the road, but if you so much as tap the bumper of a new Tesla, a Mercedes, or even a fully loaded Toyota Highlander, the repair bill for their sensors, cameras, and custom paint will blow past $5,000 before the tow truck even arrives. And that doesn't include the cost of their rental car for the weeks it's in the shop. Your insurance pays the first $5,000, and you get a certified letter for the rest. The state minimum policy isn't designed to protect you. Let me say that again. It is not designed to protect you. It is the bare-bones legal requirement the state of California imposes to make sure there's at least a tiny puddle of money available for the people you might hurt. It protects society from you, but only in the most minimal way possible. It does absolutely nothing to protect your assets, your savings, or your peace of mind. So if the state minimum is a trap, what are the right numbers? How much liability coverage do you actually need to be safe? 50/100/50? 100/300/100? 250/500/100? The answer isn't the same for everyone. It depends on your specific financial situation. And that's exactly where we're going next. We're going to give you a simple framework to determine your exact liability needs, ensuring your financial shield is strong enough to protect everything you've worked for. Let's start with a fundamental truth that most people get wrong. Auto insurance isn't primarily about protecting your car. It's about protecting your life. Everything you own, everything you've saved, and even the money you haven't earned yet. The most critical number on your policy isn't your deductible. It's your liability limit. This is the maximum amount your insurance company will pay out if you are found at fault for an accident that injures someone or damages their property. So, how much do you need? State minimums? 100,000? $500,000? The answer isn't a random number. It's a number that's deeply personal. And it's based on a simple calculation of what you have to lose. We're going to walk through this right now. Grab a pen or open a notes app, because this 5-minute exercise could be the most important financial decision you make all year. We'll call this the Asset Shield calculation. It has 2 main parts. First, you need to calculate your current net worth. This sounds complicated, but it's not. It's just a snapshot of your financial health. Start by listing your assets. This includes the equity in your home. That's the market value of your house minus what you still owe on the mortgage. Add your savings and checking account balances. Then your investments, the current value of your 401k, your IRAs, any brokerage accounts with stocks or mutual funds. Don't forget other significant assets. Do you have a second property? A boat? Valuable art or jewelry? Add it all up. This is the assets side of your ledger. Now let's look at the other side, your liabilities. This is your debt. List what you owe on your mortgage, any car loans, outstanding student loan balances, and significant credit card debt. The formula is simple. Assets minus liabilities equals your net worth. Let's use an example. Meet Sarah. She's a 35-year-old graphic designer living in Orange County. Her condo is worth $600,000, and she owes $400,000 on the mortgage, so her home equity is $200,000. She has $25,000 in savings, and her 401k is up to $75,000. Her total assets are $300,000. She has a $15,000 car loan and $5,000 in student loans left. So her total liabilities are $20,000. Sarah's net worth is $300,000 minus $20,000, which equals $280,000. This number, $280,000, is the absolute bare minimum liability coverage she should even consider. Why? Because in a serious lawsuit, that is the amount that an attorney for the other party could target and potentially take from her. But wait, we're not done. This is where most people stop, and it's a critical mistake. A lawsuit doesn't just look at what you have today. It can also target what you will have tomorrow. This is the second and arguably more important part of the calculation: your future earnings potential. If you cause an accident where the damages exceed your insurance limits, the court can issue a judgment against you. That judgment can lead to wage garnishment, where a portion of every single paycheck you earn for years, even decades, is automatically diverted to pay off that debt. Think about that. A single mistake on the road could mortgage your future. So how do we protect against this? We have to account for it. A good rule of thumb is to consider your next 5 to 10 years of income as a potential target. Let's go back to Sarah. She earns $80,000 a year. 5 years of her income is $400,000. Now we combine the two parts. Her net worth of $280,000 plus her potential future earnings exposure of $400,000 gives us a total of $680,000. This is her true financial exposure. This is the number she needs to protect. A policy with 100/300 limits, meaning a maximum of $100,000 per person and $300,000 per accident for bodily injury, wouldn't even come close to covering her. She needs liability limits that are much, much higher. You might be thinking, this sounds extreme. Does this actually happen? Let me tell you a story. It's a story that plays out in California courtrooms every single day. Imagine a guy named Mark. He's a responsible person, a good driver. He's never been in an accident. He has insurance, the kind his agent said was good coverage. 100/300/50. One rainy Tuesday, he's driving home. He glances down at his phone for just a second to check a notification. In that second, the car in front of him slams on its brakes. He can't stop in time. It's a serious rear-end collision. The driver of the other car is a surgeon. Her hands are her livelihood. The accident causes severe nerve damage in her right wrist. Multiple surgeries, months of physical therapy, and she may never operate with the same precision again. Her medical bills quickly surpass $200,000. Her lost income from being unable to work is projected to be over $1 million over her career. Mark's insurance company pays out immediately. They write a check for the bodily injury policy limit, $100,000. That's all they are legally required to do. But the surgeon's total damages are over $1.2 million. So, what happens to the remaining $1.1 million? A few weeks later, Mark gets a thick envelope in the mail. It's from a law firm. He's being sued personally for the remainder. His $100,000 policy is a drop in the bucket. The lawyers for the surgeon perform an asset search. They find his house, which has $300,000 in equity. They find his retirement account with $150,000. They find his kids' college savings accounts. They target all of it. The court sides with the surgeon. A judgment is entered against Mark for $1.1 million. His insurance is gone. His savings are wiped out. They force the sale of his family home. His retirement is gone. And even after all of that, he still owes over $500,000. So the court orders his wages to be garnished. For the next 25 years, 25% of every paycheck he earns goes to paying off this judgment. That 1 second, that one glance at his phone didn't just cause an accident. It triggered a financial avalanche that buried his family's entire future. This story isn't meant to scare you. It's meant to empower you. Because Mark's financial ruin was completely and totally preventable. For someone like Sarah with an exposure of nearly $700,000 or Mark, who clearly had assets worth protecting, the standard options aren't enough. They need a different tool. And that tool is called an umbrella policy. Think of an umbrella policy exactly like its name suggests. Your auto and home insurance policies are your jacket and hat. They provide your primary layer of protection. But when a massive financial storm hits, a torrential downpour of a lawsuit, you need an umbrella. An umbrella policy is an extra layer of liability insurance that sits on top of your other policies. It only kicks in when your primary auto or home insurance limits have been completely exhausted. So, if Mark had a $250,500 auto policy and a $1 million umbrella policy, the scenario would have played out very differently. His auto insurance would have paid the first $250,000. Then, his umbrella policy would have kicked in and covered the rest all the way up to $1 million. His house would be safe. His retirement would be safe. His future wages would be safe. His family's future would be secure. And here's the best part. Umbrella policies are incredibly cheap for the massive amount of protection they provide. A $1 million umbrella policy often costs just a few $100s a year. It is, without a doubt, the single best value in the entire insurance industry. So let's put this all together into a simple, actionable framework. Good, better, best. Good coverage means, at an absolute minimum, your liability limits should match your current net worth. Do the calculation we just did. If your net worth is $250,000, you should have at least $250,000 in bodily injury liability coverage. This is your financial survival baseline. Better coverage is the truly responsible choice. It means setting your liability limits to cover your net worth plus 5 to 10 years of your future income. This protects not just what you have, but what you're working towards. For many people, this will mean getting the highest liability limits your auto insurer offers, like $250,500, and then adding a $1 million umbrella policy. Best coverage is the fortress. This is for high-income earners, business owners, or anyone with significant assets. It means maxing out your auto and home liability limits and then adding a larger umbrella policy, maybe $2, $5, or even $10 million depending on your total exposure. It creates a virtually impenetrable shield around your financial life. So, your homework is simple. Calculate your number. Figure out your total exposure, your net worth plus your future earnings potential. Then look at your current policy. Does it cover that number? If it doesn't, you have a critical gap in your financial shield. Now you know how to protect yourself from a lawsuit if you are at fault. But there's another, equally terrifying scenario. What happens when the other driver is at fault, and they have no insurance at all? Or they only have California's tiny state minimum coverage? You could be the victim, win the lawsuit, be awarded $1 million, and still end up with nothing but medical debt and a wrecked car. That is a devastating reality for millions of California drivers. And we're going to show you exactly how to build a shield against that exact risk in the very next part. That shield is not a single piece of armor. It's a series of interlocking plates, each one designed to defend against a specific type of financial attack. And the very first, most fundamental plate is called liability coverage. This is the part of your policy that is legally required by the state of California. It's the absolute bare minimum you must have to drive on our roads. But here's the critical misunderstanding that ruins people. Liability coverage does not protect you. It doesn't pay for your medical bills. It doesn't pay to fix your car. Liability coverage pays for the damage you do to other people. Think of it as your I'm sorry fund. It's divided into two main parts. The first is bodily injury liability. If you cause an accident and someone else gets hurt, this is what pays for their hospital bills, their physical therapy, their lost wages because they can't work, and even for their pain and suffering. The second part is property damage liability. This pays to repair or replace whatever you hit. The other person's car, a city stop sign, a neighbor's fence, you name it. If you damage someone else's property with your vehicle, this is what covers the cost. Now, here is where millions of Californians make a catastrophic mistake. They look at their policy and see a series of numbers, usually written as 3 numbers separated by slashes, like 15/30/5. This isn't a secret code. It's the exact dollar limit of your protection, and for most people it's a financial time bomb. That 15/30/5 represents the California state minimum liability coverage. Let's break down what that actually means because it's terrifyingly small. The first number, 15, stands for $15,000. That is the maximum amount your insurance company will pay for any single person you injure in an accident, not a dollar more. The second number, 30, stands for $30,000. That's the maximum total amount your policy will pay for injuries for an entire accident, no matter how many people you hurt. If you injure 3 people, that $30,000 has to be split between all of them. The final number, 5, stands for $5,000. That is the absolute maximum your policy will pay for all property damage you cause in a single accident. I want you to really look at those numbers. 15,000, 30,000, 5,000. Does that sound like enough to you? In a state where the average new car costs over $50,000, and a single night in the emergency room can cost more than $15,000? This is not insurance. It's a legal loophole that allows you to drive, while leaving you almost completely exposed. Let's make this real. Let's tell the story of a driver we'll call Mark. Mark is a good guy, works in tech support, lives in Irvine. He's a safe driver, never been in a major accident. To save money, he has a state minimum 15/30/5 policy. He pays his bill every month and he feels protected. He's insured. One Tuesday afternoon, he's driving home on the 405. Traffic is slowing down faster than he expects. He glances at his phone for just a second. A notification popped up, and when he looks up, it's too late. He slams into the back of a Toyota Camry, pushing it into the Honda Odyssey minivan in front of it. A classic everyday three-car pileup. The driver of the Camry, a woman named Sarah, has a broken wrist and severe whiplash. In the Odyssey are the Johnson family. Mr. Johnson has a concussion, and his wife suffers 2 herniated discs in her back. Everyone is shaken but thankfully alive. Now let's do the math. Mark was at fault. His liability coverage is now on the hook. Sarah's medical bills, including the ER visit, surgery for her wrist, and follow-up physical therapy, come to $22,000. The Johnsons' combined medical bills, due to the more complex back injury and neurological tests, total $60,000. So the grand total for bodily injury is $82,000. Mark has that 15/30/5 policy. Remember what the numbers mean. His policy will pay a maximum of $15,000 per person. So, it pays $15,000 of Sarah's $22,000 bill. Sarah is now personally responsible for the remaining $7,000, and you can bet her lawyers will be coming after Mark directly for it. For the Johnsons, it's even worse. The policy's maximum for the entire accident is only $30,000. So the insurance company pays Mr. Johnson $15,000 and Mrs. Johnson $15,000. That's it. The $30,000 per accident limit has been reached. The Johnsons are left with $30,000 in medical bills that insurance didn't cover. Their lawyers are now coming for Mark personally for that $30,000. So far, Mark is personally on the hook for $37,000 in medical bills. But we haven't even talked about the cars yet. Sarah's Camry has extensive rear-end damage. The repair bill is $9,000. The Johnsons' brand new Odyssey minivan is declared a total loss. Its replacement value is $48,000. The total property damage Mark caused is $57,000. What was Mark's property damage limit? $5,000. His insurance company writes a check for $5,000, and their job is done. Mark is now personally liable for the remaining $52,000 to fix or replace those 2 cars. Let's add it all up. $37,000 in leftover medical bills, plus $52,000 in leftover property damage. From a simple moment of distraction, Mark, our insured driver, is now facing a lawsuit for $89,000. His savings will be wiped out. His wages could be garnished for years. His financial future is destroyed. All because he chose the cheapest policy, believing the lie that being legal was the same as being protected. This isn't a scare tactic. This exact scenario plays out in California courtrooms every single day. The state minimums were set decades ago, in an era of $10,000 cars and $500 emergency room visits. They are dangerously, irresponsibly low for the 21st century. That $5,000 property damage limit might not even be enough to replace the high-tech bumper on a modern luxury SUV, let alone the entire car. So what is the first, most critical step to building your shield? You have to reject the state minimums and raise your liability limits to a level that reflects reality. Forget 15/30/5. You should not even consider a policy with less than 100/300/100. Let's translate that. $100,000 for a single person's injuries, $300,000 total for all injuries in an accident, and $100,000 for property damage. This is the new baseline for responsible protection. For many people, especially homeowners or those with significant savings, even higher limits like $250/500/100 are a smarter choice. Now you're probably thinking, that sounds expensive. My premium will skyrocket. And this is the best part. It's not as expensive as you think. The jump from a useless 15/30/5 policy to a truly protective 100/300/100 policy is often the single cheapest, most valuable upgrade you can make. You might be talking about an extra $20, maybe $30 a month. It is a tiny price to pay to put a $100,000 shield between your life savings and one bad day on the freeway. It's the difference between buying a paper helmet and a real one. One fulfills a technical requirement, the other actually saves your life. By raising your liability limits, you've built the first and most important layer of your financial shield. You've protected your assets from the damage you might cause to others. But this shield is still facing inward. It does nothing to protect you, your passengers, or your own car from the single biggest threat on California roads, the massive number of drivers who have no insurance at all, or who are just like Marquis, carrying a policy that's nothing more than a piece of paper. Even with a fortress of liability coverage, a huge gap in your defense remains, leaving your own financial well-being completely exposed. We're going to plug that gap and forge the next piece of your armor in the next part. So you've built your fortress. Your liability limits are high, a powerful shield protecting your assets from the consequences of a mistake you might make. But what about a mistake someone else makes? What happens when the accident isn't your fault at all? Imagine this. You're driving home, obeying every law, when suddenly a distracted driver blows through a red light and slams into your side. The crash is violent. You're injured, your car is mangled, and your life is instantly thrown into chaos. But you think, okay, it's not my fault. Their insurance will cover everything. The police arrive, they write the report, and the other driver is found 100% at fault. Then comes the gut punch. The officer informs you the other driver has no insurance. None at all. Or maybe they have the California state minimum, a laughable $15,000 for bodily injury. Your initial medical bills from the ambulance and emergency room alone could eclipse that. What now? Who pays for your mounting hospital bills? Who pays for the physical therapy you'll need for the next 6 months? Who replaces the income you're losing because you can't work? Your fortress of liability coverage is useless here. It's designed to pay out to others, not to pay you. The at-fault driver? They have no insurance and likely no assets. You can sue them, sure. You might even win a judgment for hundreds of thousands of dollars. But winning a judgment and collecting a judgment are two vastly different things. You can't get blood from a stone, and you can't get money from someone who doesn't have it. This isn't a rare, one-in-a-million scenario. This is the hidden epidemic on California's roads. The Insurance Research Council estimates that 1 in 7 drivers in the United States is uninsured. In California, some studies suggest that number is even higher. That means in any group of 8 cars around you on the freeway, there's a statistical ghost, a driver with no coverage, a financial predator waiting to happen. This is where the next and arguably one of the most critical pieces of your armor comes into play: uninsured and underinsured motorist coverage. Let's call it UM/UM. This is not for them. This is for you. This is the coverage that acts as your personal financial bodyguard when you're victimized by an irresponsible driver. It steps into the shoes of the driver who hit you and pays you what they should have paid you. Let's break it down. There are 2 main parts. First, uninsured motorist bodily injury, or UMBI. This is the hero. If a driver with no insurance hits you and injures you, your own UMBI coverage kicks in to pay for your medical expenses, your lost wages, and that often overlooked but hugely important category: pain and suffering. Now you might be thinking, well, I have health insurance. Won't that cover my medical bills? Yes, it will. But with some massive, potentially devastating caveats. Your health insurance has deductibles you have to meet. It has copays for every visit. It might have strict limits on which doctors or specialists you can see, especially for things like chiropractic care or physical therapy. And most importantly, your health insurance does absolutely nothing to replace your lost income while you're recovering. It does nothing to compensate you for the pain, the trauma, and the disruption to your life. UMBI covers all of that. It makes you whole in a way health insurance simply cannot. The second part is underinsured motorist bodily injury, or UIMBI. This is the equally important sidekick. This protects you from the millions of drivers who are technically legal, but are carrying coverage so low it's practically useless in a serious accident. Remember California's state minimum? $15,000. That's it. What happens if a driver with only $15,000 in coverage causes an accident that results in $150,000 of medical bills for you? Without UIMBI, their insurance company would write you a check for their policy limit of $15,000, and that's the end of the road. You would be left personally on the hook for the remaining $135,000. It's a financial catastrophe, but with underinsured motorist coverage, your own policy steps in. It looks at your $150,000 in damages, subtracts the $15,000 you got from the at-fault driver, and it pays you the difference, that $135,000. It bridges the gap between your actual damages and the other person's pathetic coverage. So what are the right limits to carry? The answer is simple and non-negotiable. You should carry the exact same limits for uninsured/underinsured motorist coverage as you do for your own bodily injury liability. If you chose liability limits of $250/500, you need UM/UIM limits of $250/500. Think about the logic here. Your liability coverage reflects the value you place on protecting a stranger you might injure. If you believe a stranger's health, income, and well-being are worth up to $250,000, why on earth would you value your own health or your family's health at anything less? It is financial hypocrisy to insure strangers for more than you insure yourself. Matching these limits is the only logical choice. Now, a quick but important note for Californians. You might hear the term stacking. In some states, if you have 3 cars on your policy, each with $100,000 of UM/UIM coverage, you can stack them together to get $300,000 of total coverage. California is a non-stacking state. You cannot do this. The limit you see on your policy for one vehicle is the absolute maximum you'll get, no matter how many cars you insure. This makes it even more critical to choose a high limit from the outset, because what you see is what you get. Okay, so we've protected your body, your health, and your income. But what about your car? The uninsured driver didn't just injure you. They wrecked your vehicle. This is where a different type of coverage comes into play. Uninsured motorist property damage, or UMPD. In California, this is an optional coverage that typically provides $3,500 to repair your car if you're hit by a confirmed uninsured driver. Frankly, it's a weak and often problematic coverage. $3,500 doesn't go very far in a body shop these days. And the key word is confirmed. If it's a hit and run and you can't identify the driver, UMPD won't help you. You have to prove the other person was at fault and that they were uninsured, which can be a bureaucratic nightmare. For this reason, I and most insurance professionals consider UMPD to be an inferior product. The real comprehensive solution for protecting your vehicle is collision coverage. We'll dive deep into that later. But just know that relying on UMPD to fix your car is like bringing a squirt gun to a house fire. The best part about all this incredible layer of protection, your personal financial bodyguard, is surprisingly inexpensive. For the monumental shield it provides, UM/UIM coverage is one of the best bargains in the entire world of insurance. Skipping it or cheaping out on it to save a few dollars a month is one of the most reckless financial gambles a person can take. You are betting your entire financial future that you'll never be the victim of one of the millions of uninsured or underinsured drivers sharing the road with you every single day. That is a terrible bet to make. So we've now forged 2 essential pieces of our armor: the liability shield to protect our assets from others, and the UM/UIM plate to protect ourselves from others. We're far safer than we were, but there are still chinks in the armor. What about smaller medical bills regardless of who is at fault? What about covering your own passengers? There's a simple, inexpensive coverage that acts as a goodwill ambassador and a medical gap filler. And it's the next piece we need to forge. This coverage is called medical payments, or MedPay. And it's one of the most misunderstood, and therefore most tragically undervalued, pieces of your entire insurance policy. Let's demystify it right now. At its core, MedPay is beautifully simple. It pays for reasonable and necessary medical and funeral expenses for you and your passengers if you're injured in an auto accident, regardless of who is at fault. Read that last part again: regardless of who is at fault. This is the magic key. Liability coverage, which we've talked about, is all about fault. It's a slow, deliberate dance of adjusters, police reports, and arguments to determine who pays for what. MedPay just cuts right through all of that noise. It sees an injury from a car accident, and it pays the bill. Period. Let me paint you a picture. You're driving your best friend Chris to go see a movie. You're stopped at a red light and bam, a car behind you going maybe 10 miles an hour bumps into your rear bumper. It's not a huge crash. The cars are barely damaged, but the jolt was sharp. You feel fine, but Chris complains his neck is stiff and he's getting a headache. Now, the other driver is apologetic. He admits fault. But what happens next? Chris needs to get checked out. An urgent care visit, maybe an X-ray. Who pays for that? Well, technically, the at-fault driver's bodily injury liability should cover it. But that takes time. You have to file a claim. They have to accept liability. They have to process the bills. Could be weeks, even months. In the meantime, Chris has a bill for a few hundred or maybe $1,000. He could use his own health insurance, but he's got a $2,000 deductible he hasn't met this year. So, to get care for an injury that happened in your car on your watch, he has to pay $2,000 out of his own pocket and hope to get reimbursed later. How awkward is that conversation? How much strain does that put on your friendship? It creates a weird, unspoken tension. Now let's rewind. Same scenario, but you have $5,000 in MedPay coverage. The accident happens. Chris says his neck hurts. You look at him and say with complete confidence, "Chris, don't even worry about it. Go straight to urgent care. Get checked out. Whatever the bill is, just send it to me. My car insurance will pay for it immediately. No questions asked." You just went from being the driver in an awkward situation to being the hero. You took care of your friend. You preserved the relationship. The cost of that bill is no longer a point of stress between you two. That is why I call it the Goodwill Ambassador. It's a relatively small expense on your policy that pays massive dividends in your real-life relationships. And it's not just for your friends. It's for your family, your kids, your parents if you're driving them to a doctor's appointment. It covers every single person in your vehicle. So what exactly does it pay for? It's pretty broad. We're talking about health insurance deductibles and copays, ambulance rides, emergency room visits, X-rays and MRIs, follow-up visits with doctors or specialists, physical therapy, chiropractic care, even necessary dental work if a tooth gets chipped in the impact. And in the absolute worst-case scenario, it also provides a benefit for funeral expenses. Now the big question I always get is, but I have great health insurance. Why do I need MedPay? It's a fair question, but it misses the point in three critical ways. First, as we saw with Chris, your health insurance doesn't cover your passengers. Their health insurance covers them. And if they have a high deductible or a high copay, or even no insurance at all, you're back in that incredibly awkward position. MedPay covers everyone in your car, turning a potential financial problem into a simple solution. Second, MedPay has no deductible and no copay. It is first dollar coverage up to the limit you select. Your amazing health insurance plan likely has a deductible you have to satisfy first. Let's say you're in a crash and it's your fault. You break your arm. The ER bill is $4,000. Your health insurance deductible is $5,000. You are on the hook for that full $4,000. But if you have $5,000 in MedPay, it will pay the entire bill. Your health insurance doesn't even get involved. MedPay can literally pay your health insurance deductible for you. And third, MedPay is more versatile than you think. This is the part that blows most people's minds. MedPay follows you, the policyholder, and your resident family members. It doesn't just cover you when you're in your own insured car. It covers you if you are a passenger in someone else's car. It covers you if you're hit by a car while riding a bicycle. It even covers you if you are a pedestrian hit by a car while crossing the street. Think about that. You're out for a jog, and a distracted driver rolls through a stop sign and clips you. You need an ambulance and an ER visit. Your own auto insurance policy, through your MedPay coverage, can step in and pay those bills immediately, while you sort out the messy business of getting the driver's liability insurance to pay for the rest. It's an incredible safety net that extends far beyond the four doors of your vehicle. So, how much should you get? MedPay is typically sold in increments like $1,000, $2,000, $5,000, $10,000, and sometimes up to $25,000. In California, it is completely optional, which is why so many agents let clients skip it to make the premium look cheaper. This is a huge mistake. Getting the bare minimum of $1,000 is, frankly, almost useless in today's world. A single ambulance ride in a major California city can cost more than that before you even see a doctor. The cost to increase your coverage is shockingly small. The difference between a $1,000 limit and a $5,000 limit might be $3 or $4 a month. The price of a single latte. For that reason, I believe a $5,000 MedPay limit should be the absolute minimum for almost everyone. It's a meaningful amount that can cover the initial, most expensive part of an injury, the ambulance, the ER, the initial X-rays, and handle most minor injury claims from start to finish. If you have a high-deductible health plan, or if you frequently drive with passengers, you should seriously consider $10,000 or more. The peace of mind it buys is worth every single penny. It transforms a moment of panic and stress into a moment of calm and control. When an accident happens, the last thing you want to be thinking is, how are we going to pay for this? You want to be thinking, is everyone okay, and how can I take care of them? MedPay lets you do that. It's a small price to pay to be the person who has the situation handled, to be the person who can reassure a scared passenger, to be the person who can protect your own finances from unexpected medical bills. It's not just insurance for your car. It's insurance for your relationships and your peace of mind. So we've covered taking care of your passengers and your own immediate medical needs, regardless of fault. That's a powerful layer of protection. But what happens when the person who hits you, the person who is clearly at fault for your injuries, doesn't have the insurance to pay for them? What if they only have California's tiny minimum limits, which get exhausted after the first day in a hospital? Or worse, what if they have no insurance at all, and just drive away? You're left holding a massive bag of medical bills with no one to pay them. That's where our next layer of armor comes in, and it might be the single most important coverage you buy. This coverage is called Uninsured and Underinsured Motorist Protection. And in a state like California, it's not a luxury. It's a non-negotiable shield for your financial life. Let's break that name down because it's actually two separate shields rolled into one. Uninsured and Underinsured. First, Uninsured Motorist Bodily Injury, or UMBI. This is your defense against the ghost. The driver with zero insurance. The hit-and-run driver who vanishes into traffic. According to the Insurance Research Council, 1 in every 6 drivers on California roads is uninsured. 1 in 6. Look around you on the freeway next time. For every 6 cars that pass, one of them is a financial time bomb waiting to go off. If that driver hits you and puts you in the hospital, their non-existent insurance policy will pay you exactly $0. Your health insurance might cover some of the initial hospital stay, but what about the deductibles? The co-pays? What about the lost wages from not being able to work for 6 months while you recover? What about the physical therapy, the long-term rehabilitation, the pain and suffering? That's what uninsured motorist coverage is for. It steps into the shoes of the driver who hit you and pays you for your injuries, your medical bills, and your lost income, as if they had a proper policy. You are essentially buying an insurance policy for the irresponsible person who might one day slam into you. It sounds crazy, but it's the only thing standing between you and potential bankruptcy after a serious accident that wasn't your fault. Now for the second and arguably more insidious part, Underinsured Motorist Bodily Injury, or UIM. This protects you from the driver who did the bare minimum. They followed the law technically. They bought a California state minimum policy, that 15/30ths we talked about.
$15,000 per person, $30,000 per accident.
They cause a multi-car pileup on the 405. Sending you and 3 other people to the hospital with serious injuries. Your medical bills alone are $100,000. The at-fault driver's policy has a maximum payout of $30,000 for the entire accident, and only $15,000 for you specifically. So, their insurance company sends you a check for $15 grand. Congratulations! You are still $85,000 in the hole. And that's before you account for the fact you can't work, you need ongoing care, and your entire life has been turned upside down. Where does that $85,000 come from? Comes from you. From your savings. Your retirement. Your kids' college fund. Or it comes from your underinsured motorist coverage. Your UIM coverage kicks in when the other driver's liability limits are exhausted and are not enough to cover your damages. It bridges the gap between their pathetic little policy and what you actually need to be made whole again. Pays the difference up to your own policy limits. This brings us to the single most important rule about this coverage. In nearly all cases, you cannot buy more uninsured/underinsured motorist coverage for yourself than you have in bodily injury liability coverage for others. Think about that. The insurance company is essentially saying, we will not let you protect yourself and your family to a higher degree than you are willing to protect other people. So when you see someone with a $250/500 liability policy, it means they can also get $250/500 in UM/UIM coverage. But if you cheap out and only get the state minimum 15/30ths liability, you can only get a maximum of 15/30ths in UM/UIM coverage for yourself. You're capping your own recovery. You're telling the world that if an uninsured driver puts you in a wheelchair for life, you believe your entire future is only worth $15,000. It is a catastrophic mistake. People waive this coverage or get the lowest limits possible to save money. They see it as an extra expense. They think, I'm a good driver, I won't get into an accident. But this coverage has nothing to do with how good of a driver you are. It's insurance against someone else's irresponsibility. Waiving this coverage to save, what, maybe $10 or $15 a month? That is the most expensive money you will ever save. It's like canceling your health insurance to save on the premium, and then having a heart attack. You saved a few $100s to expose yourself to a bill for hundreds of thousands. Let's talk limits. What should you get? Simple. You should, at a minimum, match your UM/UIM limits to your bodily injury liability limits. If you chose 100/300 for your liability, you should have 100/300 for your UM/UIM. If you chose 250/500, you need to get 250/500 for UM/UIM. Do not create a mismatch here. Protect yourself as well as you protect others. Given the staggering cost of medical care, even a moderately serious accident can blow past $100,000 in bills before you even leave the hospital. A 250/500 limit is not overkill. In today's world, it's just prudent planning. Now, a quick but important technical point you need to know about California law. Stacking. In some states, if you have 3 cars on your policy, each with 100/300 in UM/UIM coverage, you can stack them together in a serious accident to get up to 300/900 in total coverage. It's a huge benefit, but you need to know, California is a non-stacking state. You cannot stack your UM/UIM limits. If you have a 100/300 limit on your policy, that is the absolute maximum you can get from that policy, regardless of whether you own 1 car or 5. This makes choosing a high initial limit even more critical, because the number you pick is the number you're stuck with. Finally, there's a small, often confusing cousin to this coverage called Uninsured Motorist Property Damage, or UMPD. This is designed to pay for repairs to your car if you're hit by a confirmed uninsured driver and you don't have collision coverage. It usually has a set limit, often just $3,500, and it only applies if the uninsured driver is identified. If it's a hit and run, it typically doesn't apply. Frankly, this coverage is mostly redundant and not the best way to protect your car. There is a much better way to cover your vehicle's repairs, which we'll get to in a moment. For now, know that UMPD is a small limited patch, not a full suit of armor. The real armor is the bodily injury part of UM/UIM. That's the one that saves you from financial ruin. So let's recap this critical layer. We've protected our assets from others with liability coverage. Now, with uninsured and underinsured motorist coverage, we've protected our own bodies and our own financial health from the massive number of irresponsible drivers out there. You have a shield against the ghosts with no insurance and the zombies with the bare minimum. Your medical bills, your lost income, your family's future. It's now secure. But look at what we're missing. Your body is protected. Your passengers are protected. But what about the car itself? The 2040, maybe $60,000 machine you're sitting in. What happens when the accident is your fault? Or when a tree falls on your car in a storm? What about theft, fire, or a deer that jumps out of nowhere on a dark road? Right now, with the coverages we've discussed, you're on your own. You'd be paying for that entire loss out of pocket. That's where the two most commonly understood, but most frequently mismanaged, coverages come into play. They're the ones that actually fix your car. Collision and comprehensive. These two are a package deal, the dynamic duo of physical damage coverage. Let's start with collision. The name is pretty self-explanatory, but the devil is in the details. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. Notice I said another object. That could be another car, a guardrail, a telephone pole, a rogue shopping cart, or the wall of your own garage. If you are the one doing the colliding and you are at fault, this is the coverage that saves you. Let's go back to that worst-case scenario. You're driving home, you're tired, you misjudge a turn and slam into a light pole. The front end of your car is crumpled. It's clearly your fault. The liability coverages we talked about, they do nothing for you here. Bodily injury liability pays for people you hurt. Property damage liability pays for the stuff you hit, in this case, the city's light pole. But your car? Your $1,000 phone that just turned into a $10,000 heap of metal? Without collision coverage, you are looking at a very expensive lesson in physics. You'd have to pay for the tow, pay for the repairs, or pay for a new car, all from your own bank account. But with collision coverage, you have a lifeline. Here's how it works. When you buy collision, you choose a deductible. A deductible is simply the amount of money you agree to pay out of pocket for a claim before the insurance company starts paying. Think of it as your copay for a car repair. The most common deductibles are $500 or $1,000, but you can find them as low as $100 or as high as $2,500. So, in our light pole example, let's say the repair estimate for your car comes in at $6,000. If you chose a $1,000 deductible, You would write a check to the body shop for $1,000. Your insurance company would then pay the remaining $5,000. You're back on the road for a fraction of the total cost. If you had chosen a $500 deductible, you'd pay $500, and the insurance would pay $5,500. Now you might be thinking, why wouldn't everyone just pick the lowest deductible possible? Well, there's a trade-off. A lower deductible means you pay less during a claim, but it also means you pay a higher premium every month. A higher deductible means you're taking on more of the financial risk yourself, so the insurance company rewards you with a lower premium. The right deductible for you comes down to a simple, honest question. What amount of money could you comfortably write a check for tomorrow without it causing a major financial crisis? If writing a check for $1,000 would mean you couldn't pay rent, then you should not have a $1,000 deductible. You should pay a little more each month for the peace of mind of a $500 deductible. But if you have a healthy emergency fund and can easily cover a $1,000 surprise expense, then you could save a significant amount on your premiums over the years by choosing that higher deductible. It's a personal risk management decision. So that's collision. It's for when your car hits something. But what about all the other bad things that can happen to a car? What if a tree branch falls on it during a windstorm? What if you walk out of the grocery store to find your car stolen? What if you're driving down a country road and a deer decides to redesign your front bumper? None of those are technically a collision in the way insurance defines it. For that, you need collision's partner, comprehensive coverage. Comprehensive is sometimes called other than collision coverage, which is a perfect description. It covers damage to your car from basically anything other than a collision. This is the coverage for acts of God and acts of people. We're talking about theft, vandalism, fire, riots, explosions. We're talking about natural disasters like floods, hail, windstorms, and for us here in California, the big one, earthquakes. It also covers hitting an animal, like a bird or a deer, and damage from falling objects like that tree branch. It even covers things like a cracked windshield from a rock kicked up on the freeway. Just like collision, comprehensive coverage has a deductible. You choose the amount you're willing to pay first. It's often the same as your collision deductible, but it doesn't have to be. For example, some people choose a lower comprehensive deductible because they feel like they have less control over those types of events. A cracked windshield is a very common comprehensive claim, and many companies in California will offer a separate, much lower glass deductible, sometimes even $0, so you can get your windshield fixed without a huge out-of-pocket cost. Together, liability, collision, and comprehensive are what people are usually talking about when they use the slang term, full coverage. I want you to burn this into your brain. Full coverage is not a real insurance product. It's a myth. It's a shorthand phrase people use, but if you walk into an agent's office and say, "Give me full coverage," you could end up with a policy that is dangerously inadequate for your needs. It's just an expression for a policy that has the big three components: protection if you hurt someone, protection if you damage their property, and protection for your own car. But as we've already seen and will see in the next parts, there are still massive gaps that can leave you exposed. Now, there's a giant critical concept we need to address when talking about collision and comprehensive. It's the source of more arguments and frustration with insurance companies than anything else. It's the concept of actual cash value, or ACV. When your car is damaged, the insurance company agrees to pay to repair it. But what if the cost to repair the car is more than the car is actually worth? At that point, the insurance company will declare your car a total loss. And here's the part that trips everyone up. They don't pay you what you paid for the car. They don't pay you what it costs to buy a brand new car. They pay you the actual cash value of your vehicle 1 second before the accident happened. Actual cash value is essentially the fair market value. It's what a willing buyer would have paid a willing seller for your car right before it was destroyed. They look at the year, make, model, mileage, condition, and recent sales of similar cars in your local area to determine its value. They account for depreciation. Your 2018 Honda Civic with 80,000 miles is not worth what you paid for it in 2018. It's worth what a used 2018 Honda Civic with 80,000 miles is worth today. Think of it this way. ACV is what you could have reasonably sold your car for on Craigslist 5 minutes before the crash. This is a hard pill to swallow for many people. They feel like they're being lowballed. But you have to remember the fundamental purpose of insurance. It's to indemnify you. That's a fancy word that means to make you whole again. It's designed to put you back in the same financial position you were in before the loss, not a better one. They give you the cash value of the car you just lost so you can go out and buy a similar comparable used car. So, the final question is, do you even need collision and comprehensive? The first answer is simple. If you have a loan or a lease on your car, the answer is yes. You are required to have them. Your lender or leasing company owns part or all of that vehicle, and they are going to mandate that you carry these coverages to protect their financial interest until the car is paid off. But what if you own your car outright? What if it's an older car, paid for years ago? This is where it becomes a financial decision. You have to weigh the cost of the coverage against the potential benefit. A good rule of thumb is to look at the actual cash value of your car. You can get a rough idea from a site like Kelley Blue Book. Then, look at your insurance policy and see how much you're paying per year specifically for the collision and comprehensive portion. If your car is only worth, say, $3,000, and you're paying $700 a year for collision and comp, you're paying almost a quarter of the car's value every single year just to insure it against physical damage. After you subtract your $1,000 deductible, the most the insurance company would ever pay you is $2,000. In that situation, it might make more sense to drop those coverages, bank the $700 you're saving each year, and effectively self-insure. You're betting that you can avoid a major at-fault accident or catastrophic event. And if one does happen, you'll use the money you save to either repair the car or buy another cheap one. It's a calculated risk, but for many people with older, low-value cars, it's the right financial move. Now, making that calculated risk on your own car is one thing. You're in control of that decision. But what about the risks you can't control? I'm talking about the other drivers on the road, because you can be the safest, most defensive driver in the world, with a perfectly maintained car, stopped at a red light, and still have your life turned upside down by someone else's mistake. And here in California, there's a terrifyingly high chance that the person who hits you has no insurance at all. This brings us to the single most important coverage you might be tempted to skip: uninsured and underinsured motorist protection. Let's call it UM/UIM for short. Do not skip this. I'm going to repeat that. Do not, under any circumstances, skip this coverage. Here's why. The Insurance Research Council estimates that about 1 in every 7 drivers in California is uninsured. In some parts of Los Angeles, that number is closer to 1 in 4. Think about that. On your daily commute, you are sharing the road with dozens, maybe hundreds of people driving illegally, without a single dollar of liability coverage to pay for the damage they might cause. So let's play out the nightmare scenario. You're driving home from work. Someone runs a stop sign and T-bones you. It's clearly their fault. Your car is wrecked. Your arm is broken. The other driver is okay, they get out, they're apologetic, and then they drop the bomb. I'm so sorry, I don't have insurance. What happens now? If you don't have uninsured motorist coverage, the answer is mostly nothing good. You can sue them personally, sure. But let's be brutally honest. If someone can't afford a basic insurance policy, what are the odds they have $50,000 in assets sitting around to pay for your medical bills and a new car? The odds are virtually zero. You'll win a judgment in court that's worth less than the paper it's printed on. You are left holding the bag for everything. Your medical bills, your lost wages from not being able to work, your pain and suffering, the cost of your totaled car. Everything. This is what uninsured motorist coverage protects you from. It essentially lets your own insurance company step into the shoes of the at-fault driver's non-existent insurance. There are 2 key parts to it. First is uninsured motorist bodily injury, or UMBI. This is the big one. If an uninsured driver injures you or your passengers, this coverage pays for your medical bills, your lost income, and your pain and suffering, up to the limits you select. And my advice here is simple. You should carry the exact same limits for UMBI as you do for your own bodily injury liability. If you have 100/300 liability to protect others, you should have 100/300 UMBI to protect yourself. It makes no sense to value a stranger's health more than your own. You are protecting your own financial future from someone else's irresponsibility. Then there's the underinsured part. This is just as important. Let's say the person who hits you does have insurance, but they only have the California state minimum of $15,000 for bodily injury. Your hospital bill alone is $80,000. Their insurance will pay out its max of $15,000, and that's it. They're done. But if you have underinsured motorist coverage of, say, $100,000, your policy can then step in and cover the remaining $65,000 of your medical bills. It fills the gap between their pathetic coverage and your actual expenses. There's also a property damage component, called uninsured motorist property damage, or UMPD. This pays to repair or replace your car if it's damaged by a known, uninsured driver. It typically has a limit of around $3,500. Now this is a bit of a weird one. For it to kick in, the uninsured driver usually has to be identified. If it's a hit and run, UMPD often won't apply. In that case, you'd need your collision coverage. But if you decided to drop collision on an older car, having UMPD is a very cheap safety net to at least get something back if an identified, uninsured driver wrecks your car. The bottom line is this: UM/UIM is not a luxury. In a state like California, it is a fundamental necessity. The extra cost per month is tiny compared to the catastrophic financial ruin it prevents. Okay, moving on from the big, scary stuff, let's talk about another often misunderstood coverage: medical payments or MedPay. MedPay is simple. It covers medical or funeral expenses for you and any passengers in your car who are injured in an accident, regardless of who was at fault. You could run your own car into a tree, and MedPay would still cover your ambulance ride and emergency room visit, up to the limit you choose, typically small amounts like $1, $2, $5, or $10,000. Now the first question everyone asks is, why do I need MedPay if I have health insurance? It's a great question, and there are several very good answers. First, your passengers. What if your friend, your coworker, or your nephew is riding with you and gets hurt? Do they have health insurance? Do they have a high deductible? MedPay covers them without any drama or awkward conversations. It protects the people in your car, period. Second, there are no deductibles or copays with MedPay. Your health insurance might have a $5,000 deductible you have to meet before it pays a dime. MedPay is first dollar coverage. It pays from the very first dollar of your medical bills, which can be a lifesaver for covering that health insurance deductible. Third, it's fast. Liability claims and lawsuits can take months, even years, to settle. Health insurance companies can sometimes drag their feet. MedPay usually pays out very quickly, getting you the money you need for immediate expenses right when you need it most. And finally, it can cover things your health insurance might not, like dental injuries, chiropractic care, or ambulance fees, which can be surprisingly expensive. For the few extra dollars it costs per month, MedPay provides a fantastic layer of immediate, no-fault financial protection. So we've covered the core of the policy: liability, collision, comprehensive, uninsured motorist, and MedPay. Think of these as the foundation of your house. But what about the extras? The little upgrades that make life easier when things go wrong? Let's talk about the common add-ons or endorsements. First up is rental reimbursement. This is exactly what it sounds like. If your car is in the repair shop after a covered claim, meaning an accident or event your policy is paying to fix, this coverage pays for a rental car. Without it, you're paying out of pocket. And that gets expensive fast. Imagine your car is in the body shop for 3 weeks. Even a cheap rental at $40 a day is over $800 you'd have to pay yourself. Rental reimbursement coverage is usually very cheap, and it's structured with a daily limit and a total limit. For example, $40 per day up to a maximum of $1,200. My advice? Before you select a limit, do a quick search on Kayak or Enterprise to see what a basic rental car actually costs in your area. You might find that the default $30 a day limit won't even cover the taxes on a compact car anymore. Next is towing and roadside assistance. This covers you if you need a tow, run out of gas, lock your keys in the car, or need a jump start. It's a convenience coverage. But here's the key: check if you already have this somewhere else. Many people have AAA. Many credit cards offer roadside assistance as a perk. Some newer cars even come with it from the manufacturer for a few years. If you already have a service you like, there's no need to pay for it again on your auto policy. But if you don't, adding it to your insurance is often the cheapest way to get that peace of mind. Finally, let's talk about a big one, especially if you have a car loan: GAP insurance. GAP stands for Guaranteed Asset Protection, and it covers a very specific and very dangerous financial situation. When you buy a new car, it depreciates or loses value the second you drive it off the lot. Your car loan, however, does not. This creates a gap where you owe more on the car than the car is actually worth. Let's use an example. You buy a brand new car for $40,000 with a small down payment. You have a loan for $38,000. 1 year later, you get into a major accident and the car is declared a total loss. Because of depreciation, the insurance company determines the actual cash value of your car is now only $30,000. They write you a check for $30,000, but you still owe the bank $34,000 on your loan. So the insurance money pays off most of it, but you are now left with a $4,000 bill to the bank for a car that no longer exists. You are paying for a pile of scrap metal. That is the gap. And gap insurance is designed specifically to pay off that difference. It's absolutely critical if you're buying a new car with a small down payment, or if you're rolling negative equity from a previous car into your new loan. You can usually buy it from the dealership, but it's almost always cheaper to add it as an endorsement to your auto insurance policy. Once you've paid down your loan to the point where you owe less than the car is worth, you can call your insurance company and have it removed. Now, gap insurance is what we call an endorsement or a rider. Think of these as small, optional power-ups you can add to your main insurance policy to customize it for your specific needs. And this is where you can go from having a generic one-size-fits-all policy to one that's perfectly tailored to your life, often for just a few extra dollars a month. Let's talk about the most important ones, starting with a coverage that sounds minor, but can save you a massive headache: rental reimbursement. Picture this: you get into a fender bender. It's not your fault, but your car needs to be in the body shop for 2 weeks. The other person's insurance will eventually pay for the repairs, but that process can take time to get started. In the meantime, you still have to get to work, pick up the kids, and live your life. So you need a rental car. Without rental reimbursement on your own policy, you're paying for that rental car out of your own pocket. We're talking $40, $50, maybe $60 a day in California. For 2 weeks, that's over $700 you have to float, hoping you get it back later. Rental reimbursement coverage solves this. For usually less than the cost of a cup of coffee per month, your insurance company will pay for a rental car while yours is being repaired after a covered claim. But here's the key detail most people miss. It's not unlimited. Your policy will show limits, like 30/900. This means the policy will pay up to $30 per day, for a maximum total of $900. In today's market, $30 a day might only get you the most basic compact car. If you drive an SUV and need a similar-sized rental for your family, you might want to increase those limits to $50 or $60 a day. It costs pennies more, but it's the difference between being comfortable and being crammed into a tiny car for weeks. It's a small choice that makes a huge difference when you actually need it. Another incredibly common endorsement is roadside assistance or towing and labor. You've probably been offered this. It covers things like getting a tow if you break down, jumping a dead battery, changing a flat tire, or even bringing you a few gallons of gas if you run out. Now you might be thinking, isn't that what AAA is for? And you're right, it's very similar. The main difference comes down to cost and how it's applied. Getting roadside assistance through your auto insurer is often cheaper than a standalone AAA membership. We're talking maybe $10 to $20 for the entire year. However, here's the catch you need to be aware of. Using your insurance company's roadside assistance could count as a claim on your record. Now, it's a minor claim and many companies say it won't raise your rates, but some might. If you have to call for a tow 3 times in 1 year, an underwriter might see you as a higher risk. AAA, on the other hand, is a membership club. You can use their services as much as your membership level allows, and it has zero impact on your insurance. So the choice is yours. Save a little money with the insurance endorsement, or pay more for a separate membership that keeps your insurance record completely clean. There's no wrong answer, but you need to know the trade-off you're making. Okay, let's move into some of the lesser-known endorsements that provide incredible value, especially if you've personalized your car. This is called Custom Parts and Equipment Coverage, or CPE. The standard auto policy is designed to cover your car as it came from the factory, and that's it. So what if you've upgraded it? What if you spent $3,000 on a beautiful set of custom wheels and tires? Or $1,000 on a new sound system? What if you got a custom paint job or a vinyl wrap? If you get into an accident and those custom parts are destroyed, your standard policy will only pay to replace them with stock, factory-level parts. They'll give you the value of the boring 17-inch factory wheels, not your stunning 20-inch custom rims. All that money you invested is just gone. This is where CPE coverage comes in. For a very small premium, you can add $5,000, $10,000, or even more in coverage specifically for these aftermarket editions. You just need to keep your receipts to prove their value. If you have done anything to your car that didn't come from the factory, a lift kit on your truck, a high-end stereo, a roof rack, you absolutely need to ask your agent about this coverage. Otherwise, you're driving around with thousands of dollars of uninsured equipment. Along those same lines is another crucial endorsement for people who value their vehicle's integrity: the OEM endorsement. OEM stands for Original Equipment Manufacturer. This means parts made by your car's maker like Toyota, Ford, or BMW. When your car is repaired after an accident, Insurance companies will often approve the use of aftermarket parts to save money. These are generic parts made by third-party companies. While they're designed to fit and function like the original, the quality can be inconsistent. An aftermarket fender might not line up perfectly with the door, the paint might not match exactly, or the material might be a thinner gauge of metal. For an older car with a lot of miles, this might not be a big deal. But if you have a newer car, a luxury vehicle, or a car you're just passionate about, you want it repaired with the real thing. The OEM endorsement guarantees that the insurance company will pay for original, factory-made parts whenever they're available. This ensures the best possible fit, finish, and quality, preserving your car's safety and resale value. It costs a little more, but for anyone who refuses to compromise on quality, it is non-negotiable. It's the peace of mind of knowing your car will be put back together exactly the way it was built. Now let's talk about two coverages that are often confused, but are critically different: new car replacement and the previously mentioned gap insurance. We know gap pays the difference between your car's value and what you owe on your loan. It protects your finances. New car replacement, on the other hand, protects your asset. This coverage is typically available for cars that are only 1 or 2 model years old. If your brand new car is totaled in a covered accident, instead of just giving you a check for its depreciated, actual cash value, the insurance company will pay to replace it with a brand new car of the same make and model. Let's be clear. The second you drive a new car off the lot, it can lose 10% of its value. After a year, it could be down 20% or more. If you paid $40,000 for a new SUV, and it's totaled a year later, its actual cash value might only be $32,000. That's all the insurance company has to give you. New car replacement coverage ignores that depreciation and gives you the money to go buy another brand new one. It's a premium coverage and not every company offers it. But if you're buying a new vehicle, it provides the ultimate protection against that initial steep drop in value. Finally, let's demystify one of the most heavily marketed perks out there: accident forgiveness. The commercials make it sound like a get-out-of-jail-free card. Have an accident and poof, we'll pretend it never happened and your rates won't go up. And it does work like that, but there are important conditions. First, it typically only applies to your first at-fault accident. Second, you usually have to earn it. Most companies require you to be a customer and remain accident-free for a certain number of years, often 3 to 5, before the benefit kicks in. You can't just buy a new policy and expect to have accident forgiveness on day one. Some companies will let you pay extra to have it immediately, but it's not standard. So, is it worth it? Absolutely. A single at-fault accident can cause your premium to skyrocket by 30, 40, or even 50% and stay that way for 3 years. Accident forgiveness can literally save you thousands of dollars. When you're shopping for insurance, ask how their accident forgiveness program works. What are the specific requirements to qualify? Knowing the details separates the marketing gimmick from the genuinely valuable policy feature. These endorsements are the building blocks of a truly great policy, turning a basic safety net into a fortress of protection customized just for you. So how do you make this fortress affordable? Because let's be honest, a policy that breaks the bank isn't a good policy, no matter how comprehensive it is. This is where the art of the discount comes in. And in California, the discount game is strong, but you have to know how to play it. Most people know the basics: the multi-policy discount for bundling your auto and home or renter's insurance, and the good student discount. These are the low-hanging fruit. But we're not here for the basics. We're here to become experts. Let's talk about the biggest potential game changer in modern insurance: usage-based insurance or telematics. This is where you agree to let your insurance company monitor your driving habits, usually through a smartphone app or a small device you plug into your car. It tracks things like how hard you brake, how quickly you accelerate, the time of day you drive, and your total mileage. Now I know what you're thinking: privacy. And that is a 100% valid concern. You have to decide your comfort level. But the potential savings can be massive. If you are a genuinely safe, low-mileage driver, a telematics program could cut your premium by up to 30 or even 40%. It turns your good driving from an abstract concept into a tangible financial reward. Conversely, if you have a lead foot and a habit of driving late at night, it could potentially work against you. The key is to be honest about your driving habits and read the fine print of the program before you enroll. Next up, the low-mileage discount. California is a commuter state, but the rise of remote work has changed the game. If you're driving significantly less than you were when you first got your policy, you need to tell your insurance company. Many insurers offer substantial discounts for driving under a certain number of miles per year, often around 7,500 or 10,000 miles. Don't pay for a 15,000 mile a year habit if you're only driving 5,000 miles. That's just giving away money. Then there are the professional and affinity discounts. Are you a teacher, a nurse, an engineer, a first responder, or active or retired military? There are often specific discounts for your profession. Are you a member of a certain alumni association, a credit union, or a wholesale club? Many of these organizations have partnerships with insurance companies that can unlock special rates. You will almost never be offered these unless you ask. You have to proactively say, "I am a member of this group," or "I work in this profession. Do you offer a discount?" And don't forget the simple stuff. Taking a certified defensive driving course can often knock a percentage off your premium for several years. Having anti-theft devices, from a simple VIN etching to a sophisticated alarm system, can get you a discount on your comprehensive coverage. Going paperless, setting up automatic payments, paying your entire premium in full upfront. These are all small, easy wins that can add up to real savings. The single most important takeaway here is this: discounts are not automatic. Insurance companies are not actively searching for ways to charge you less. You must be your own advocate. Ask your agent or a company representative to do a full discount review with you. Go down a checklist. It's a 5-minute conversation that can save you hundreds of dollars. Now we've built the policy. We've made it affordable. But all of this is just theory until the one day you actually need it. The moment of truth for any insurance policy isn't when you pay the bill. It's when you have to file a claim. This is where the promises on paper collide with the hard reality of a very bad day. Understanding the claims process before you're standing on the side of the road, heart-pounding, is one of the most powerful things you can do. The worst has happened. You've been in an accident. First things first, your safety is the only priority. Move to a safe location if you can. Check on everyone involved. Call 911 immediately if there are injuries or significant damage. Always file a police report. This single document can become the most critical piece of evidence in your claim, providing an objective, third-party account of the incident. Then document everything. Your smartphone is your best friend in this moment. Take more photos and videos than you think you need. Get wide shots of the entire scene showing the position of the cars. Get medium shots of the damage to all vehicles. Get close-ups of specific points of impact. Take photos of the other driver's license, their insurance card, and their license plate. If there are witnesses, get their names and phone numbers. The more evidence you gather at the scene, the smoother the process will be. Now it's time to contact your insurer. Most top-tier companies have a mobile app that allows you to start the claims process right there at the scene. You can upload photos and provide a statement immediately. This is often the fastest way to get the ball rolling. If not, call the dedicated claims hotline. Once the claim is filed, you'll be assigned a claims adjuster. This person is your primary point of contact. Their job is to investigate the accident, determine who is at fault, and assess the extent of the damages. They will review the police report, your statement, the other party's statement, and all the photos. They'll then estimate the cost of repairs. This brings us to a critical fork in the road: the repair shop. Your insurance company will likely have a network of preferred or direct repair program shops. The benefit of using one of these is that the process is often streamlined. The shop and the insurer have a pre-existing relationship, and they can often handle the payments directly, meaning less hassle for you. However, you need to know this. In California, you have the absolute right to have your vehicle repaired at any shop of your choosing. If you have a trusted mechanic you've used for years, you can take it there. The insurer is still obligated to pay for the covered repairs, but the process might involve you getting an estimate, submitting it for approval, and potentially paying out of pocket before being reimbursed. The choice is yours. Throughout this process, communication is key. Keep a log of every conversation you have with the adjuster, including the date, time, and what was discussed. Don't be afraid to ask questions. If you have rental reimbursement coverage, ask how to set it up. If your car is declared a total loss, ask how they determined its actual cash value, and be prepared to provide your own evidence if you believe their valuation is too low. A smooth claims process is what separates a great insurance company from a mediocre one. And that is the final piece of this puzzle. How do you choose the right company to begin with? Because the cheapest price from a company that will fight you tooth and nail during a claim is not a bargain. It's a future nightmare. First, look beyond the commercials and the funny mascots. You need to investigate a company's financial stability. You are paying them to be there to cover a potentially massive loss. What if they can't? Independent agencies like AM best rate the financial strength of insurance companies. You want to see a rating of a excellent or better. This tells you they have the capital to pay out claims, even in a widespread disaster. Second, and arguably most important, is their reputation for customer service and claims handling. How do they treat their customers when things go wrong? This is where you become a detective. Look up J.D. Power's annual auto insurance studies. They rank companies based on customer satisfaction with shopping, billing, and most critically, the claims process. Another invaluable resource is your state's Department of Insurance. The California Department of Insurance website has a complaint ratio tool. It shows you how many complaints a company receives relative to its size. A company with a consistently high complaint ratio is a major red flag. Finally, consider the user experience. In today's world, this matters. How good is their website? Is their mobile app easy to use? Can you easily access your policy documents, make payments, and file a claim online? A company that invests in a smooth digital experience is often a company that values its customers' time. So let's bring this all home. We've journeyed through the entire landscape of California auto insurance. We started with the absolute non-negotiable foundations of liability coverage. We built on that with the physical protection of collision and comprehensive. We shielded ourselves from the unknown with uninsured and underinsured motorist coverage and handled immediate medical needs with MedPay. We then customized our policy with powerful endorsements, turning a generic product into a bespoke suit of armor. We learned how to make it affordable by hunting down every last discount, and we demystified the claims process, turning a moment of panic into a series of clear, manageable steps. You are now equipped with the knowledge that the vast majority of drivers on the road simply do not have. You understand that an insurance policy isn't a commodity you buy once and forget about. It's a dynamic, living document that needs to adapt to your life. So here is your final call to action. Sometime in the next 24 hours, I want you to go and find your current auto insurance policy. Find the declarations page. That's the summary of your coverages and costs. Look at it with these new eyes. Look at your liability limits. Are they high enough to protect your life savings? Look at your deductibles. Are they at a level you could comfortably pay tomorrow? Do you have uninsured motorist bodily injury coverage? Are you missing out on discounts for being a safe driver or working from home? The 10 minutes you spend reviewing that document could be the most valuable 10 minutes of your year. It could save you thousands in premiums, or it could save you from financial ruin after an accident. You are no longer just a consumer of insurance. You are the architect of your own financial security. You have the blueprint. Now go build your fortress.